On Business Incorporated today, Kenya Central Bank orders dollar rationing. And Tanzania mining reform produces more than 44 gold trading centers. Zimbabwe now measures inflation using a weighted average of items priced in Zimbabwean dollars and the United States dollars. Good afternoon. Welcome to Business Incorporated here on Channels Television. It's a fresh week, so let's start off with what's going on in the market. As usual, let's look at the numbers right here. We see that it's a good one for the NGX of Nigeria. Starting off on a green note, after the elections, 0.18% positive at 55,629.96. Perhaps the market is happy with the result of those elections. In South Africa, it's also positive, looking even better there, 0.36 at 78,574.25. We look at other parts of Africa. Egypt is deeply in the red, not deeply, but in the red, 0.06% at 16,818.19. Kenya closed on Friday, marginally down, also 0.03%. And then moving over to the Middle East, sentiment at intraday, we see it's more of positive. Abu Dhabi, more than 10,000, that's 1.01%. Dubai also heading really close to that 1% positive at 3,449.51. In other region there, we see Saudi Arabia also in the negative 0.02%, and Qatar in the positive at 0.69%. More than 0.5% positive at intraday. That's for Qatar. Let's go to Berlin, where a German Chancellor Olaf Scholz has returned from his first visit to the United States since Russian forces invaded Ukraine a year ago. We have a new person joining us from DW. Marie Sinai joins us from Berlin. Hi, Marie. Good to have you on the show. We hope to have more of you. But tell us, what was the result of that meeting between the two leaders at this crucial time?
Well, this meeting had one main purpose. It was a strong show of unity against Russia, and it was a chance for the two leaders to coordinate on Ukraine in private. That's because the meeting was held just between Biden and Scholz, and it was held behind closed doors. Now, after the meeting, President Biden said that both leaders would work in a lockstep to provide military support to Kiev, and that's significant because since the last official visit of Scholz to the United States, 12 very consequential months have passed. For Germany, this year marked a seismic turning point. And that's because the country went from having a largely pacifist foreign policy outlook to one where it is now investing in its military again and also sending advanced weapons to Ukraine. And its decision to, in January, for example, provide Ukraine with Leopard tanks is one big example of this shift that happened in Germany, a country that ditched its post-war hesitancy for military intervention since Biden and Scholz last saw each other in person. And this shift in Germany was also a result of diplomatic pressure from the US to do so. So this visit is a way of cementing this common path that Germany and the US are now on, and to underscore transatlantic unity on Ukraine. And both leaders also vowed to keep Western support for Ukraine intact during this meeting, and that all is happening amid rising concerns about China.
China obviously has been a source of worry for the United States and Germany in recent time. Is it just about their increase in budgets for their weapons, or is there something else?
Yeah, so Biden and Scholz both share mounting concerns that China could move to supply weapons to Russia, essentially then supporting its invasion of Ukraine militarily. And the US has said that it obtained intelligence that suggests that China could provide lethal support to Moscow. And this is all happening against the backdrop that Chinese President Xi Jinping is an ally of Russian President Vladimir Putin, and he has also yet to condemn Russia's invasion of Ukraine. Now, China has denied the reports, but Germany and the US are still very concerned about the prospect. And that's because on the one hand, of course, it would mean prolonging the war, but on the other hand, it would also completely transform their respective relationships with China. Now, the US has stated that if China were to indeed supply weapons to Moscow, it would sanction China. And for Germany, on the other hand, that's a touchy subject because Germany is a big trading partner of China and it economically depends on its ties to the country. So until now, Germany has tried to be a mediator in this case. So the situation is really one where both leaders, both Biden and Scholz, share a concern over China's involvement, but they differ in the sense that the US is much more hawkish. It is much more willing to take punitive measures against Beijing if Beijing indeed crosses that line. So this was certainly a topic that was discussed.
Yeah, and it looks like it's a topic that will be discussed for a long time because, as you noted, Germany will not be so fast to agree to sanctions. Let's look at the markets now. How's that looking?
Yeah, so much like Biden and Scholz, European investors also have their eyes on China at the moment. And that's because China's National People's Congress kicked off its annual gathering in Beijing yesterday on Sunday. And during this meeting, it was already announced that China will have a growth target of 5% for this year. That's a very moderate growth target, and it's actually the lowest growth target to come out of China in decades. Now, investors will be looking at any other announcement that will impact the world's second largest economy that will impact China to come out of this Congress. And also in other news, there is one interesting item from the Frankfurt Stock Exchange. They'll be listing German defense company Rheinmetall in the blue chip index DAX from now on. Now, Rheinmetall is the maker of the Leopard tanks that are currently being sent to Ukraine. That company has seen its share price almost double over the past 12 months.
Yeah, Marie, thank you so much for bringing us up to date. We hope to talk to you again tomorrow. All right, let's move to the UK now, where Juliana is standing by. Juliana, good afternoon. We've been talking about the anti-strike law before now. Now, the UK government is getting a warning from European Convention on Human Rights, saying that that law might be a breach. What's the UK saying about it, and what more do we know about this?
That's absolutely right. Good afternoon, Innie. Well, remember that this kind of anti-strike law was first put together by the Prime Minister and the government late last year, and this was in response to a huge winter of discontent where at one point up to 1 million individuals had downed tools from across sectors, most notably rail and health, because they weren't happy, of course, with pay, jobs and conditions. So Rishi Sunak, the Prime Minister, decided to put a bill forward to lawmakers which would require a minimum service level, basically saying that these services would be able to function if indeed strikers decided to down tools. Also, the bill goes on to say that some union bosses could actually be hauled to court and fined a considerable amount of money if their strikes cause considerable disruption. Now, of course, this hasn't gone down well with union bosses who basically say, well, what's the point of striking if you are not at work and your work can still continue? That is not going to have the desired impact. So that has been the mood music from the opposition Labour Party, from union bosses here, and also from some critical observers. Now, the bill went through the House of Commons quite quickly, as to be expected, because the Conservative Party have quite a sizable majority in the House of Commons. It is now going to go for a further reading in the House of Lords. That's how bills are passed in the UK. So on, I believe, Thursday, the 9th of March, lawmakers that sit, or peers as they're called, that sit in the House of Lords, will also get to decide whether or not they agree with it. In the meantime, a mixed group group of MPs who form part of the Joint Convention of Human Rights have written a 48-page report, and they do talk about the European Convention of Human Rights. We are no longer part of the EU, but we are still a member of that international body that basically protects human rights. And there is an article within that, I believe it's Article 11, which does state that it is a human right for workers to be able to associate. So they're just flagging this up before it goes for a further reading on Thursday, just to say, look, are you sure that this bill, dots all the I's, crosses all the T's, and is legal? Because, people should be able to strike. So it is very controversial. Of course, the government have said that, they're doing everything. They've checked the laws. They are within their rights to do this. However, let's see whether or not members and peers of the House of Lords agree when the bill finally gets to them on Thursday morning.
All right, we'll certainly hear from that on Thursday. But even with the threat of strike or anti-strike law, Starbucks is coming to the UK with 100 new stores this year. That should do something to unemployment.
Hopefully, unemployment is still relatively low internationally, historically, very, very low. Lots of vacancies. I think, in fact, we've got a record number of vacancies in the UK at the moment. But this story, good win. Starbucks has obviously been in the UK for way over a decade. I believe they've got about 1,000 stores up and down the land. Pretty expensive to get a Starbucks coffee, I must say. It's probably going to cost you about £4. I don't know what that is in Naira at the moment. 400 Naira? 4,000 Naira? Gosh, it fluctuates a lot, so forgive me, Innie. But yes, this has put an end to speculation that Starbucks could be leaving the UK. There was a serious rumour, actually, last year, because there are so many alternatives. Pret a Manger is very, very popular. Costa coffee, even McDonald's, Greggs, people go there for cheaper coffees. But clearly that's not the case. They are staying in the country. They have made an announcement that they are going to invest about £33 million over the next 12 months. Much of that is going to go into these new stores. They're going to create 100 new stores, but also they said they are going to refurbish existing stores to make sure they can stay abreast of the competition. Sales have been doing pretty well. I believe last year sales were up 26% to about 444 million. However, pre-tax profits are down by about 10%. That could be for various reasons. So yeah, good win for Britain. Another kind of vote of confidence for the Chancellor in the Treasury.
Yeah, good news. At least we have that. Let's look at the market now. How's that looking at this time?
Not great, very much in the red. We did have another survey looking at small businesses, pretty much saying the same thing they've been saying for the past 8 months. They're struggling. Confidence is low. Investment projections are pretty low. It's really, really difficult in the UK to get skilled workers to stay in the job, to maintain the position. And this is having an effect because, of course, if you don't have enough people to work, then all of the work gets piled on your existing staff, which is one of the reasons why we have significant amount of striking in this country, because people are not happy with doing that, especially if they're not going to get paid for it. This is affected the numbers at intraday, and the FTSE All Share is down. It's down 0.26%. The FTSE 100 down at 0.30%, and the FTSE 250, the domestic market, up slightly by 0.19%. In the currencies market, the British pound is currently trading down against the US dollar by 0.17%, down 2 against the euro by 0.16%, and at intraday, the British pound is down against the Japanese yen by 0.18%. In
All right, market there, Juliana. We hope it to be better before the close of trade today. Thank you so much.
Yeah. Thank you.
All right, Juliana takes us to a break, and then when we come back, we'll head to the African continent. There are a lot of stories we have there for you. Do stay with us. This is Business Incorporated on Channels Television. Welcome Welcome back to watching Business Incorporated here on Channels Television. We stay in Africa now. Growing shortages of foreign exchange on the interbank market in Kenya has reported by the Central Bank of Kenya to ask financial institutions to ration purchases by Kenyan businesses. The shortages have forced Kenyan firms to seek greenbacks on alternative markets where the exchange is higher than the official rate. Some financial institutions are said to have imposed caps as low as $5,000 for a day. The imposed limits make it difficult for Kenyan manufacturers and importers to meet their obligations. The shortages, which reportedly began in mid-2022, suggest that the country's foreign currency woes are worsening. In October of last year, the CBK statement denied Kenyan Deputy President claims that the country lacked foreign exchange to import oil. The central bank insisted at that time that all the forex used for oil import is sourced from commercial banks. The executive added that while some fortunate businesses have secured as much as $50,000, these funds are still far below what they need. From Kenya, we move to Zimbabwe, where the country is now measuring inflation using a weighted average of items priced in Zimbabwean dollars and the United States dollars. Previously, the official rate was based only on items on the local currency. In its 2023 monetary policy statement released earlier, the Reserve Bank of Zimbabwe Governor Dr. John Panonetsa asked economic players to focus more on blended inflation since large parts of the Zimbabwean economy had been dollarized. The USD is widely used in the country alongside the Zimbabwe dollar and South African rand. The government relaunched the Zimbabwean dollar in 2019 after a decade of dollarization. But in 2020, it authorized the use of foreign currencies as part of measures to respond to the COVID-19 pandemic. And in Egypt, the gold reserves, which is a major component of foreign cash reserves, has reached $7.37 billion. That's at the end of February, slightly lower from $7.77 billion that it had in January. The Central Bank of Egypt notes that foreign currencies value included in the cash reserve rose to $26.96 billion by the end of February, compared to $26.13 billion by the end of January. The central bank also announced the rise in foreign reserves to $34.352 billion by the end of February, compared with $34.224 billion by the end of January, and that's an increase of $128 million. Foreign currencies in Egypt's foreign reserves consist of the United States dollar, euro, Australian dollar, Japanese yen, and the Chinese yuan. Still staying in Egypt, the country's Purchasing Managers Index, the PMI, for non-oil private sector upped slightly in February to 46.9 and went up from 45.5, which was seen in January, remaining below the 50 neutral mark, according to data from Standard & Poor's Global. S&P stressed that the country's non-oil economy remained in a steep downturn in February as demand continued to be hit by high inflation and supply chain pressures. As a result, employment fell at the fastest rate in 9 months, and business confidence was at a near record low, according to the report. On the other hand, the report pointed out that inflationary pressures on the sector's businesses eased from January's recent highs. A bit of good news there for Egypt, hoping the country can build on it. Now, moving elsewhere now, the government reforms in the mining sector has continued to yield results, collected about 400 billion revenue from the sector in 2 years, and that is talking about Tanzania mining reform. The reforms made by the government included the establishment of an international gold trading center in the gold-rich region, which has 5 buying centers that have made trading easier for small-scale miners, reduced transport costs, and ensured taxes due to the government are paid. The reforms also led to the creation of at least 44 gold trading centers and 70 other minerals trading centers across the country, which have helped to stop smuggling of minerals outside the country. And in Nigeria, the central bank has said that about 503 billion naira has been repaid by smallholder farmers under the Anchor Borrowers Program, the ABP. According to the CBN, this figure represents 52.39% of total repayments as at February this year. The CBN's acting director of communications, Abdulmunin Issa, made this known while highlighting the performance of the Anchor Borrowers Program in a briefing with journalists in the country's capital, Abuja. Mr. Issa notes that the ABP has contributed significantly to the increased national output of focal commodities such as maize and rice, adding that the bank remains committed to its developmental mandate of stimulating access to finance for the rail sector. Last week, however, the International Monetary Fund had disclosed that only 24% of loans disbursed under the Anchor Borrowers Program of the Central Bank of Nigeria have been repaid. Just before we go, let's see a little bit of markets now, and we head straight to the United States to see how that market fared. That's for the futures, and we can see the numbers. They're not looking very, very good, at least for some part of it. So the Dow Jones, we see, was down. The futures 0.04%. The S&P, however, marginally, just at the tip there, 0.01. Or the Nasdaq, marginally up at 0.09%. We can also tell you what happened in Asia markets. We can say that stocks in Asia Pacific traded as investors digested China's growth target set in its parliamentary sessions and looked ahead to a week of economic data. In Australia, the S&P AX 200 rose 0.62% to end its session at 7,328.6, ahead of the Reserve Bank of Australia's decision Tuesday, with economists surveyed by traders expecting to see a 25 basis points hike in its cash rate. The Nikkei 225 was up more than 1% to close at 28,237.78. The Topix climbed 0.84%. In South Korea, the Kospi gained more than 1% to 2,462.62 as the nation's inflation showed further easing in February. In mainland China, the Shanghai Composite fell 0.19% to 3,322.03, and the Shenzhen Component inched up slightly, 0.1% lower, to 11,842.88. After Chinese Premier released the nation's government work report on Sunday, the Hang Seng Index struggled for direction and last rose 0.2% in its final hour of trade. Well, we'll close with the markets today. We'll do it again tomorrow, see what stories we have for you on Business Incorporated from Africa. I'm John Mekwa. Enjoy the rest of your day.